Ladies and gentlemen, welcome to the first ever Geology Q&A session of the Independent Speculator. Joining me today is Ron Parratt, who's on screen now. Famed for most of my readers for the tremendous success he had at AUEX Ventures, but also a multiple discoverer, an Explorers League honoree for finding gold in Nevada, a strange place to look. And Brent, if you could say something, so Zoom will switch to you. Let's make sure you're here with us as well.
Yeah, still here.
There you go. Okay, the technology is working. So also joining us is Brent Cook, my fiercest competitor of Exploration Insights. Not really. The pie's big enough for more than the both of us, I think. I won't go too speechifying here, but it occurs to me now that I do have a glitch here in my plan. I need to be able to see the YouTube as well as you gentlemen in order to be able to see the questions from the readers. So I may need to switch to a phone or some other backup so I can see the YouTube questions. But we'll manage that. So while I'm doing that, let me quickly say thank you both for joining me. I'm very happy that you're with me. I like to joke when I'm at the podium at these investment conferences that I'm not a real geologist. I just play one on TV. You guys are real geologists. And though I've learned a thing or two and might be able to answer some questions here, I'm really glad to have you guys with me on this show because we want to do our best to get this as right as we possibly can and be as useful as we possibly can. All right, so I do have some questions sent in advance, and we'd had lots of inquiries, so I assume we actually have an audience out there. I'll check on that momentarily. But while I'm doing that and setting up the questions on my phone so I can read off what people are sending in while we're live, I want to ask both of you one question, exercise my prerogative as moderator of this show. One question for both of you as geologists who understand economic geology and the junior space in particular. Let's start this off by my big question, and that's this. We get these press releases, and they're full of jargon. You know, blah, 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 degrees of potassic alteration, blah, 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 argillic alteration, blah, 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 blah. All this stuff in there. And then maybe 5 paragraphs down, oh, by the way, the drill didn't find anything. Or no, sometimes, sometimes they don't. Sometimes it starts with a nice headline, you know, drill finds this, or fails to find this. And then it goes into the blah, 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 blah. So here's the question. Is that blah, blah, blah really necessary? Or is it really just window dressing? You know, how often is it used to confuse the reader, make it sound very scientific? Oh, we have all these things and wonderful things. But does the average investor, this press release is not for the Geological Society of whatever, it's for investors mostly. And it seems to me that a lot of these press releases are written as though they're addressing some learned society of scholarly academic geologists full of all this jargon. So the question is this necessary? And when you see tons of jargon, is that a red flag? Are they really trying to snow the reader, or is that actually necessary for context? So Brent, you're on the screen. Why don't you take that one first? And then we'll see what Ron has to say. And hopefully I'll have my phone set up here for the other questions coming in live.
Right. That's a good question. Good start. I mean, that's where we get all the information, most of the information that we're expected to make an investment decision on. I think the first thing to remember is, particularly in the Canadian market, these news releases are really intended to be promotional pieces. And I think it is very necessary to include all the data, you know, not just the holes you drilled, the holes that are close to it, maps, sections, interpretations, all that has to be there, because really that's what I suspect Ron and I are looking for. But I think a good news release starts off with a couple of, you know, 2 or 3 basic paragraphs that are directed at a retail investor who is not, you know, not a geologist or a mining engineer, to give them the sense of what's being said down below. So yeah, I think it's critical to include that. And if you look at Australian ASX listed companies and their news releases, they in general include a hell of a lot more information than Canadian companies do. And that's helpful. So in summary, yeah, I think it's really important to include as much of the data, interpretation, and expectations so that someone like Ron or myself or any number of analysts can look at it and make an informed opinion. But it should also include something simple enough that anyone can understand it as well. That's my opinion.
All right. So it's necessary to have that stuff in there. Does it ever twig your spider sense there when you see a bunch of the blah, blah, blah before you get to the meat of the subject? Or am I just being oversensitive on that?
Again, I think it should start off with the basics. This is what it should mean to your retail investor, and then the details. What I find worse is a news release that doesn't include details. To me, that tells you one or two things. Either they're trying to hide something or they're incompetent.
All right, very well. So Ron, let's get your 2 cents in on this. I think you'll need to speak up to get Zoom to switch over to you. But yes, go ahead and give us your take, and then I'll see if I have follow-up questions.
Sure, and I'd say broadly speaking, I would agree with Brent. I mean, a lot of the people that we address press release to when we're putting them together would be technical people who understand what we're talking about. A lot of the analysts with the major firms are geologists by education. They understand some of the language and the lingo. Obviously, you'd much rather report a big intercept in a drill hole and not have to be worried about the ancillary data that goes along with that, about why you drilled, where you did, what you found, what kind of alteration, what kind of geochemistry, geophysical anomalies, all the data that come together in determining where you're going to be out drilling on a given property. So it's good to relate that information as well. I would agree that I think there should be a short summary at the beginning right away. This is what we found, this is what we did, and then get into the data that supports the position that you've taken.
All right. Well, is there ever too much data, or does your spider sense ever tingle with the sense of, these guys are talking a lot, but there's not a lot of results in here?
I've seen good examples of that. A couple of pages of detail that just goes well beyond what I think is needed to explain why you did what you did or what the results may mean. Finding a very strong arsenic anomaly in a drill hole might be interesting, but you don't need 3 pages of supporting information to talk about average grades and 2 standard deviations away from crustal abundance and things like that. So.
All right, very well. Okay, so what I'm doing now is I'm setting up a second computer, so I'll be able to see the questions on the YouTube channel there while we discuss. And while I'm still doing that, I have a couple more questions that were sent in advance. So let me start with that, and then I will go to the new questions that those of you who are watching live kind enough to share with us. Much appreciated. And so one of them is that I know that it's hard to answer. One size doesn't fit all, but maybe there's some pointers that we can give the audience on how to address grade, basically. What is high grade? And I think most of the audience is sophisticated enough to understand that high grade for an open pit is different from high grade from an underground. And of course, the different metals have different grades. I do have a sort of cheat sheet, rule of thumb article on this on the Independent Speculator website called What is High Grade? But you guys are geologists. So what do you look for in a press release? What makes you say, oh, that's a really high grade, or that looks rich enough to matter? Are there any guidelines you can give us, Ron, and then we'll switch back to Brent?
Well, I guess high grade would mean in a sense, ore that you can mine that has a very high return attached to it. If that's in an open pit mine, someone might say that 2.5 grams per ton is high grade. 1-to-1 strip ratio, 85% recovery, that's going to yield a very good return. Some people would say, well, 1.5 grams is pretty high grade. I begin to get questionable about that, again, depending on strip ratio, metallurgical recovery issues like that. Underground, is totally different. As we all know, the cost of mining underground is much more expensive than open pit mines. If you see a high grade intercept, what's reported as a high grade intercept, and it's 3 or 4 grams per ton, you need to know a lot more about that intercept to understand whether it really even is ore. If it's very deep, if it's metallurgically challenging, even though it sounds like an interesting intercept, it may not be one that's going to be attractive economically. We see Barrick put out numbers for their 4 Mile deposit in Nevada of 80 grams per ton and 55 grams per ton, stunning, intercepts. Those are clearly high grade. Even super high grade would not be inappropriate in a case like that. The typical underground mine around the world is not like that, though. If you're above 1/4 of an ounce per ton, 1/2 ounce per ton, those are good grades that can work depending on the situation.
Okay. All right. Brent, anything to add on that? I know it's a big giant can of worms, but it's probably the #1 question I get. People look at these and they look at the grade. Help me understand grade.
Well, it's not that simple, as Ron pointed out. I think one general rule of thumb that is useful for me is when a resource is published, your average grade should be at least twice the cutoff grade. And that's the general rule of thumb that, it's a starting point. But as Ron pointed out, really, when we look at a drill hole or of some sort, it's, you take the value of the ore times metallurgy, so call it 0.7, and you've got to subtract the strip ratio, how much it's going to cost to move to get to it. And you've got to look at, continuity between drill holes. Does the mineralization actually connect, or is it all chopped up? There is so much involved in that. It is tough, but certainly, you look at the grade, metallurgy, but, a 1 gram per ton at surface oxide deposit in Nevada is high grade, in my opinion. Marigold's making money on 0.4 grams, but a 1 gram refractory deposit in Nevada isn't worth anything. So you've really got to take all those things into account.
All right. So do you actually do that when you see a press release? Do you go through, okay, gross metal value times, assumed recovery, assumed, you have to make a string of assumptions if it's early stage and you don't have any of that data. You actually go through that exercise when you look at the drill results?
Yes, definitely. And certainly when I go out on a project, both Joe and I, it's you look at the rock and then you build a mine around what you're seeing to figure out, what's the capex going to be? You on a side of a road or in the middle of nowhere? Is it all helicopter supported? What's the strip ratio? Is there a church sitting up on top of the ore body? All those things come into it. Is the cartel just down the road, and are they friendly or not? That. So much comes into it. I wish it'd be nice to say, wow, this is fantastic. They just drilled 10 meters at 10 grams. But it all has to be put into context to make an informed, speculation.
Indeed. Yeah, it brings to mind many things, but in particular, Assay, Canada's former highest grade, and I'm not pushing anything here, but just pointing out, former highest grade gold mine had a cutoff approaching 1 ounce per ton was the cutoff. And that's because it was really expensive and it had nasties in the ore. They needed to have that high cutoff. So it was not crazy for them to walk away from 25 grams per ton. Yeah, it was high grade, but it wasn't economic for them back then. So all good input. Okay, I think I've got the technology sorted out here. So what I usually do in my Q&A sessions is alternate between questions sent in advance and questions live from the audience. And again, Brent and Ron, this is a friendly conversation. If anybody wants to disagree or jump in or answer, just go ahead. It's just the 3 of us. So, knock yourselves out. I want to have fun and I want to be as educational as we possibly can.
It's the 3 of us and the World Wide Web, as I understand it.
Well, yes, we hope we have a lot of people watching. I do have quite a few questions here now that I've got my technology sorted out. Can't say how many people are watching right now. It's not a Zoom thing, but in terms of interruptions, nobody else is going to barge in and ask irrelevancies. Did you have something you're about to add, Brent?
Nope, that's it.
Okay. All right. We have one question about evaluating sites for extraction potential. Do we get multiple geologists evaluating a site? Do they tend to agree with each other? Or they come up with a diversity of opinions? He's not saying necessarily like on a bank's trip for due diligence or explaining what the context for that question is, but it's a general question, site evaluation. One geologist, a team, and what happens if they see things differently? I have my own thoughts on this, but go ahead, Brent, you're on screen, take it away.
Right, let me give you a good example, actually. When I first went and looked at Ron's discovery there, AUX at Long Canyon, what I saw, my interpretation was that there are very narrow zones of Carlin-style mineralization, oxidized, in between large blocks of barren limestone. And they're dipping at that angle into a hillside like this. And I thought, well, this will never work. Obviously, Ron had a different idea, and he was right. But it's all about interpretation and what you've seen from other places. I mean, I think the advantage that we have as geologists working all over the world is we've seen so much that we can go to a project and kind of say, put it in context with other things we've seen. And different people have seen different things. So certainly there is a lot of geology is not an exact science. It's half art and half bullshit. And half reality.
There's so many ways I could go with that, but I want to get to the Q&A. But I have to say that reminds me of something that I've heard repeatedly, and it seems to me tracks with my experience of successful companies, and that is the successful geologists are not just the sort of algorithmic linear thinkers who follow the procedure. They have this artistic side, this interpretive side. And I think the reason for that is because you have to be able to think in 4 dimensions, really, not just 3, not just think, how does this go underground, but what happened in the past? What might have happened? How could it be? How could it be turned? And not everybody can turn rock upside down in their heads like that. And the more artistic types seem to be able to do that. You need a combination of artist and scientist. Would you agree with that, Brent?
Certainly. Yeah, you've got to think in 3 or 4D, as you say, and draw on, because all you're seeing is, you're seeing 2D at surface, maybe 3D, but the holes are so far apart, you're seeing only a very small fraction of what's there. And you're making these interpretations based on really very little data. Is that right, Ron?
Oh, absolutely. I mean, particularly when you go on an early stage project that you think could be interesting, you're dealing only with surface data, usually. Geochemistry, geologic mapping, maybe some rock chip chemistry, that kind of thing. And you're extrapolating, this scant data that you have on the surface down hundreds of feet, if not thousands of feet below you to envision what could be there. And different guys will come up with different ideas. I always wanted to have a geologic team where, broadly speaking, in a sense, nobody thought the same. You don't want a group of geologists to go out to a property and they all look at it and they all agree. If you've got 3 guys and they all agree about what could be there, I really probably think I only need 1. In that case, I'd rather get some different ones out there that challenge ideas so that you can come up with the best possible idea, the best possible scenario that you can develop out of the data you have that makes sense, geologic sense. And as Brent said, many of these things, you see other properties in other areas. For Nevada, it could be a comparison with a property in Argentina that you say, I've seen something like this before. And in that case, we found this to be true, and this was just a blind cap, and we know we can drill through that, let's say, and maybe find something that's of value beneath it. So different ideas are really good, and coming up with the best idea to test a target.
All right, well, I'll throw my 2 cents in as a non-geologist, having a similar question early on, perhaps. one of my first field trips back in 2004 when Doug Casey was just teaching me everything I could learn. I went to see Gold Bar out in Nevada. White Knight had it at the time. I was there with Hans, what's his name? From Newmont. Hans, the geophysics guy from Newmont. I know his name. Pardon me?
Rasmussen?
Yes, Hans Rasmussen. That's it. It's just couldn't get it off the tip of my tongue. And so we went out to look at this, and there were 5 geologists at the time. There was, the project geologist, senior geologist, Hans. There was some VP, and then was some other analyst who was a geologist as well. I don't think it was you, Brent. Might have been Bob Bishop or somebody who really knew his stuff. So we're going down this canyon, and there's 5 actual professional geologists there, and somebody sees this rock and says, "Oh, what's that?" And then one says, "Oh, that's this chert. No, that's a jasperoid." Another one jumps in. Hans says, "Well, the geophysics says," and there was one rock, and there were 5 opinions as to what it was and what it meant. It reminds me of that Zen saying of the student looking in the pool of goldfish, and there's 10 goldfish in there, and the master says to the student, "What do you see?" And the student says, 10 goldfish, 11 universes, because he includes himself. And that's my experience with geology. And I loved it. Instead of saying, "Oh, these guys are momos, they don't know what they're talking about," I said, wow, this is the scientific process happening before my eyes, right? Hypothesis, argument, data, disproof, new hypothesis. I loved it. I thought that's exactly what I wanted to see. So this is a long-winded answer to the short question of basically the more geos you can get to look at something, the better.
Yeah, I totally agree. To a point. You don't want 8 or 9. A team of 3 or 4 is kind of
a committee.
ideal.
We don't want a committee.
Yeah,
Got
to
it.
come up with rational ideas.
Okay, all right. Well, let me go to another question sent in advance. Basically, it's the old PEA versus PFS versus BFS. How much weight do we put on any of these studies? And even the bankable feasibility study can turn out to be wrong, drastically wrong at the end of the day. So what are the other ones worth? Are they worth reading at all? Why bother? How useful are these things to you? What do you think, Ron?
Well, in the end, it all comes down to economics. And at some point, you have to begin to make an economic assessment of what you may have or may not have. Obviously, different people will do a better job, maybe, not throwing stones at anybody here, but some are better than others. But you need to have some early judgment that tells you that you've got rock that's worth $60 a ton, and you're going to spend so much money to mine it. You're going to get a certain recovery from it. You've got capital costs. You've got infrastructure costs, perhaps you have to put into that, and to come up with some beginning idea. It's not like on a PEA, very early stage evaluation. You don't have reserves at all. Of course, you have maybe a resource. So you're just trying to, can this make sense or not economically? Is it real close? Is it really attractive economically or not? It's kind of this iterative process you go through, either in drilling to decide to see what you have in the 3rd dimension, but then also to begin to look at the economics and see, is it really worth continuing with work on this property or not? Is it too marginal? Maybe you can break even on what you have in a PEA. Well, I wouldn't be real excited. I'd be asking, what do I need to do to this to get the economics to improve? Where do we need to drill? What resource do we need to have to make it look better, and so forth? But they're just a yardstick to try to begin to make a preliminary look at the economics of the project. And I think that's important.
All right. Well, actually, I liked it better when they called the PEA scoping study, because I thought it was a little more honest. And PEA sounds very technical, preliminary economic assessment. Whereas a scoping study, it's kind of like, well, here's this idea.
Mm-hmm.
Brent, have 2 cents to chime in on the economic studies?
Yeah, I mean, I read everything I can, on something. So I'll look at the PEA all through up to the feasibility study when trying to evaluate a project. And my experience is that, officially a PEA, I think, is plus or minus 50%. Yeah. The next level is plus or minus 30%. And when you get down to feasibility, in theory, I think it's plus or minus 12% in terms of the outcome. My experience is that by and large, the preliminary economic assessment, your scoping study, is almost always skewed to the positive. And, the reason for that, I'm not sure. I mean, I think you've got to consider this consulting group that's doing the study. They want continued work. They want to get the next phase where they make, a lot more money on their consulting and engineering and such. And I think that's something you've got to take into account. When I see a very positive PEA, I'm a bit, I look through it and say, where are they making the wrong assumptions? Is it the mining costs? Have they got mining down to $1 a ton? Big red flag. Metallurgy, do they have the metallurgy right? Like I looked at one the other day on this project in Alaska, and the PEA came out reasonably positive with the assumption that using bio-leach on this semi-refractory ore would work. However, there had been no work done using bio-leach. It was just an assumption that was thrown into the assessment as like, well, if this works, this works.
Would the bugs even be happy in Alaska? I'm not sure that works in my mind in the winter.
Well, exactly. There are issues.
So actually, I appreciate all these responses, and I get it. And at the very least, the study gives you more data. Right? You were talking about how in the press releases, you want to see all the data you can get. So the study gives us a lot more information. It gives us an idea for strip ratio and many of these other key variables. So at the very least, they're a source of more detailed information about a proposed project. So they're worth something there. But I think what the reason for the question is that the numbers often seem to change so much. And it seems like, the PEA projects, oh, this is going to be 58% IRR. And then the PFS is like, well, no, it's more like 40, which is still very robust. And then the BFS is, well, it's more like 30. And then the mine starts up and it loses money. Well, not always. But so, is there a bias in the engineering community to try to give the best possible results? You kind of hinted that, but let's not mince words. On the one hand, they can't be totally bullshitting or they'll lose business. On the other hand, if they have a reputation as a stick in the mud, they'll lose business. It's kind of a no-win for the engineers. And I've always wondered about this. I've seen these studies with some of these just amazing assumptions, let's say. How does an engineer sign off on this? I'd like both of your input on this. And Ron, I'm trying not to get you in trouble. I know Brent doesn't care. He's retired. But, what's up with that? I mean, how can you say some of these things with a straight face?
Well, I guess after the decades I've been doing this, people in the industry, and some are going to be a little more generous. They're going to make estimates that are more on the high side, perhaps for the reasons that Brent has mentioned, maybe to encourage the company to continue with the project. That some are more realistic, and some that are the sticks in the mud where they understand what they're doing and they understand there's a lot of variability here, and so they're more conservative, in their estimates. I think part of it too is, as you get, the engineers more involved, if you're lucky and you have a project that's evolving from an early stage now to something that looks pretty attractive and it's growing, you tend to get more conservative. The engineers want to be more conservative and not slapping engineers, but when that project starts up and begins to run, they want to meet their targets. And if you look, for instance, at the ore grade, maybe the geologic modeling that's been done indicates the grade is 0.17 ounces per ton. Well, they might cut that back a little bit, maybe back to 0.15 or 0.14 to have a little bit of cushion on the grade, because they have concerns about the variability and the resource modeling. The grades are indicated better, but they're going to use a lower number. They might do the same on metallurgy, so that the feasibility study might be not quite as robust, but if they're smart and they're building in a little bit of cushion in this thing, have a better chance of meeting their goals and making sure the project's going to work. Is that honest? Is it fair? I'd say probably, as Brent mentioned, even at a feasibility level, the resource and the economics are plus or minus 10%. It's a pretty big window that you have to deal with. So I think it just depends on who's doing it, where you're at in the project, and the reasons then would fall from that.
Okay, Brent, you want to add any further comments on
Yeah,
that?
actually, I think the big issue, where the biggest problems come from, is when a resource estimate is handed to the engineering side of things. The engineering side just takes that number as is and works with it. And if the resource estimate is not accurate, it doesn't matter what they do in engineering, because they're modeling and mining an ore body that doesn't exist as they see it. And we've seen that, like Rubicon's Phoenix was a big blow up. I think even Pretium comes down half the grade.
I'll give you that one.
Half the grade than what was originally put out there, right? So if the big thing is figuring out, is this resource estimate, does it reflect reality?
Yeah.
And most busts come because they're assuming continuity in grade that may not actually be there. Another little helper would be look at the coefficient of variation, which is the CV value in a resource estimate. It's just CV in the number. The higher that number is, the more nuggety and erratic the mineralization is. And that means the more detailed drilling that has to be done, infill drilling, to get the resource right.
Right, and so people would need to go beyond the press release for that usually, go to the actual 43101 report to find that. Yeah. Fair enough, okay. We could probably talk studies all day, and then we have other questions here, so I want to move on, but I want to throw in one other tidbit I find useful, and that is just keep in mind that the IRR is kind of the end all. It's the bottom line, because you need the internal rate of return to be above certain levels to get financing. If it's too low, you're not going to get the money to build the mine, and I get that. But the IRR is in some ways the most easily manipulated, in my view, and particularly for small projects. If you have a $1 million capex, it's really easy to get a ridiculously high IRR. You make a couple $1 million, woohoo, 300% IRR, right? So just sort of word to the wise to resource investors out there. If you see a really high IRR number on a very small project, expect an extreme degree of variability there. If anybody cares to disagree with that, go ahead. Meanwhile, I'm going to pull up the next question here.
A lot of busts on projects, and CapEx can be one. Metallurgy and resource in my experience, are the two biggest causes of blowups on projects. The resource estimate gets blown, just like Brent has said, with a nuggety deposit that there's assumed continuity, and it turns out not to be there. And then metallurgy, there was a copper project near Tonopah a number of years ago that blew up because the metallurgy was missed. There was another element in the ore deposit that fouled up the metallurgy and caused the recovery of copper to be very low. Totally missed in all the metallurgical work they did, and in the feasibility study, and the project within months shut down. It was a big loss.
Yeah, I remember that.
Metallurgy and resources are two big things.
Sorry, go ahead. I remember that with Andina, with the Volcan project. They had, I don't know if it was a scoping study, but there was a preliminary assumed recovery rate of 80+%, 80 to 90%. And then further testing, it was down to like 60%. I mean, just totally changed the project and economics, for something way up high in the Andes like that. Actually, so the next question we have from the live audience segues into what Brent brought up, and they are asking specifically about Pretium and the difference of opinion, including two people present today, about that resource and the way it was handled. And the question is not so much to beat up on Pretium, but just to say, how does the non-technical guy out there, or gal out there, the investor, seeing different experts with different views on, something technical like that, like Pretium's research, how do they know what to do? Who to believe? Brent, this is your puppy, so let's get your 2 cents first.
Wow. how do you know who's right? That goes back to one of your earlier questions in the 5 geologists with 5 different theories, right? I think, and it's key, and I think you've said this before as well, is this is a very technical field. And if it's not your area of expertise, it's worth putting out the money to listen to someone who that's their job, be it a stockbroker, newsletter writer, whatever. When I was writing, behind Exploration Insights, I would spend a lot of time on this sort of thing. And you've got to build up confidence with the people you're working with, or you're selling your information to. And I think a lot of times, given the internet, people expect everything for free. More often than not, you get what you pay for, in my opinion. So find someone you trust who knows the industry and is, you feel is honest, and listen to them. That's my view.
All right, fair enough. Ron, anything to add on the who do you trust when the experts disagree question?
Well, the Brucejack deposit, as I understand it, I'm by no means an expert on that property, but it's quite deep. It's high grade, and it kind of sets up these issues with how far do you project those grades, underground. You mentioned the Eskay Creek mine, super high grade, similar in a way to Pretium's Brucejack deposit. But how do you feel comfortable extending those very high grade zones of mineralization? How far can you push those? And it just seems to me like the high grade kind of dominated the resource estimate. And what came between these high grade zones was a lot of lower grade material that resulted obviously in, once they got down and began to mine, the composite grades coming out of the stope certainly had high grade, but had a lot of lower grade, and the averages just came out less than were projected by the earlier models. That's all I could imagine would have happened.
All right. Well, I'm going to add my 2 cents here, because I think it's only fair and right, given the question, to do a little bit of a mea culpa here, because I was one of the people that disagreed with Brent, who was saying it's nuggety, it's not reasonable to make these assumptions. I know Brent had a lot of issues with the way Pretium was proceeding before they built the mine. And I understood the arguments. I didn't just dismiss Brent out of hand, my friend. But they kept hitting more of these high-grade pockets, like everywhere, all over the place. And it just seemed a little too draconian to me to be too conservative here. And I have to say that I was wrong. There was a reason for the assumptions. There's a reason why the best practices in the industry, they may feel constrictive at sometimes. You got all these fantastic drill results, and you don't want to throw them out or cap them too aggressively. But they're there for a reason, and those best practices have evolved over decades. So, there's just no ifs, ands, or buts about it. You look at how things have played out with Brucejack. There is a gold mine there. There's a lot of gold there. That's not the point. It was never a fantasy. But should it have been envisioned the way it was, and should it have been built the way it was, and maybe a different mine plan would have worked better from the beginning. And so I got to tip my hat to Brent here and say to the audience that I'm sometimes I'm getting older, and the older I get, the more the conservative, tried and true ways of doing things in this business seem reasonable to me. For what it's worth.
Well, I think that's the reason, for the conservatism with engineers. In part, the geologists and engineers are going to build these models, but obviously sometimes they don't come together the same way. And so when you're asking for $300 million or $400 million to build a mine, maybe we should work on a more conservative model here with some of these numbers, and put a bigger plus and minus on mining costs, on metallurgical recovery, on the resource estimate itself, see how the project looks, and hopefully it'll still be economic and attractive enough for lenders.
All right. Well, Brent, unless you've got something else, I've got another question sent in advance here. And actually, I'll ask it quickly and answer it because this really isn't a geology question that's related. I have a thesis that I called Success in Progress. And basically, I'm very risk averse as a speculator. I'm a speculator, not a gambler. I like trends in motion that I can bet on. And discovery is never a trend in motion. Discovery is something that you work at for years until you have your overnight success, as Ron can well attest. You know, that discovery hole is not predictable, even with the best in the business, in my view. So after the discovery hole, and you know, you have what I call evidence of success in progress. They just keep hitting. It's consistent. They're hitting. There's something there. And the question is how big, not is there anything there at all? And I've been asked, how do I know? How do I know when something is a success in progress? And the answer is, there isn't really, this isn't a geological concept. There's no measurement here. I can't say that after exactly, you know, 3 rounds of successful drilling, I'm willing to call that a success in progress play. It would make a difference, for instance, if we're talking about a big disseminated ore body that needs to be consistent on widely spaced drilling or it's not going to work, versus a vein that's you expect to have more variability. So to try to answer this quickly, I would just have to say, it's kind of, I want to say it's a feeling, but that's a very mushy answer. But when I see the press releases and you just have this feeling, yes, you know, they just keep hitting. There's real predictability here. And so maybe that's the harder way to answer this. Is the geological model working? They say, you know, they have an idea, it's a vein, it dips this way. And they hit, you know, they keep hitting it. Well, their model is working. So maybe that's a way of looking at success and progress. But the basic idea is, you know, except with play money or a prospect generator that has lots of kicks at the can, I'm very reluctant to put any serious amount of money into a company that says, oh, we got this great project, we're going to make a discovery here before it happens. That's just too high risk for me. So that's a Lobo thing. That the success in progress is not a geological concept. It's one of my sort of rules of thumb as for my own investments. If either of you gentlemen want to kick me for that or say anything, you're welcome to while I look for the next question.
I look at it as, I mean, it's real basic. A good project keeps getting better. A bad project keeps getting worse.
Yeah, I like to say the good projects help you out when you need a good drill hole. You know, you keep drilling and you'll get good results. The good ones provide that, and they grow and they get better. Yeah.
So actually, that's maybe a useful thing to add here. I mean, I've heard it also said, oh, drilling kills projects. So if that's a fear you have, if you're looking at possibly speculating on something and you're worried that drilling could kill this project, that's too early to be called success in progress. I wouldn't go there myself. Okay, so the next question we have from the live audience is about the Lassonde curve. And specifically along the curve, is there data that you look for in the press releases that gives you confidence that this project is going well, it's going to be a mine, it's going to deliver as hoped? What, if any, specifics do you look for in the pre-production sweet spot, as I call it, in press releases? Ron, you're on screen, so why don't you comment if you have any?
Oh boy. I guess when I'm reading someone else's press release and I'm trying to get a sense of the project and how they're doing with it, I certainly more outlandish statements about how great it is don't register too well with me. I like something that's pretty measured and factual and quantitative. We've drilled these holes. They're on 200-foot centers, 100-meter centers. We continue to get mineralization that's confirming our geologic model for this deposit. The ideas we have are holding up. The cyanide soluble drill data that we're getting off the drill holes continues to come in consistent with what we're seeing in the other holes, 75 to 95% recoveries, a consistency in the data reporting that shows that the original holes that perhaps made a discovery are now being extended. The model that they're using is holding up. There's no surprise coming that, oh, gee, we got lucky on one hole, we got good recovery. We drilled these other ones, though, and they're refractory and we're not getting good grades. And then you drill another hole offsetting that and they're good again. You know there's an issue, with the metallurgy developing that you're going to have to deal with down the road. So I guess I'm looking for what I consider to be measured, not necessarily conservative, but measured responses in the press release that relates the data, how it compares in an ongoing fashion to what they've seen before and what they hope to find going forward.
You always sound so reasonable, Ron. Brent, do you have anything else to add? A firebomb to throw in there?
I wish. No, I think Ron nailed it. Really, does the data and results you're getting support your original investment thesis? And I will say something I learned the hard way is once that stops happening, sell. Doesn't matter. I don't care if I lose money, get out. If the data doesn't support your investment thesis, run away.
Wholeheartedly agree. And actually, to give credit where due, you're actually one of the people that taught me this, specifically Gold Quest. You got out, you got a big win, you got out, and I was too optimistic, let's just say, and did not end up with a big win on that one back in the Romero discovery. So I could just say, kudos and absolutely very important point there. All right, another question I have in advance is another can of worms type question, but a nice one. How long should it take between drilling and results? And, I have to say before we even go there that of course 2020 is an odd year. You've got COVID shutdowns. Who the heck knows what that does to the labs? But let's set 2020 aside. And does it make a difference if you got RC chips versus diamond drill core, and there's seasonality there? I know there's a number of factors, but let me put it this way. If a company announced drilling, say, January, how many months down the road without a press release before you start worrying that something's wrong? Brent, you're on camera. Any thoughts about assay turnaround times?
Excluding this year, which has been a stuff up, I think 3 to 6 weeks is plenty of time normally to get results back. Now, when the company puts them out, it's kind of depends on where the stage of the project. If your initial drill holes, you might put out 3 or 4 at a time. If you're into definition drilling, wait till you get enough samples and results back to make sense of what's to be sensible. That's my opinion.
All right, Ron, any thoughts on assay turnaround times?
No, I'd agree with that. There is a difference, I'd say, between core and RC chips. I mean, when you have samples coming off a drill rig, RC cuttings, they can go right into a lab. They can get dried. They can get crushed, pulverized relatively quickly, depending on the business cycle that we're in at that point. When gold prices are up and everybody's very active, they can raise money and doing a lot of drilling. The labs may not staff up as quickly as maybe you'd like them to, and so things will go a little slower during those busy times. But you should be able to get fire assay data back on, let's say for gold anyway, to me within 3 weeks. I'd start really arguing with guys, what are you doing if you're not? With core, it can take a bit longer because core is going to come into a lab, depending on who you have split the core. You're going to have to either hammer and chisel it, or you're going to saw it, get it down into intervals that you want to then send in for assay. You've got coarser rock, so they're going to have to do some more crushing to get that material down in size, right? So that could add a few days to a week, let's say, anyway, on turnaround.
All right. Can either or both of you comment on what constitutes material results that the company has to press release? Like, let's say, for example, it's an early stage exploration program. They have a 10-hole drill plan that's going to test, various theses, and they're getting the results back. And their thought is, well, it's a first pass, so we want to put out the whole set of fences or whatever we're doing. We're going to put out all 10 holes together. And that's, not an unreasonable thing to say. We don't want to scare anybody off before we have a full initial look. But let's say one of the holes comes back with some, juicy high-grade hit, that is clearly material. Do they have to press release that? What are the guidelines here? Ron, you're on camera, so why don't you go ahead first?
Well, obviously, if it's a junior non-operating company, no mines, they're looking to make that big discovery, and they get an intercept that's maybe 15 meters of 10 grams, that ought to be released right away. Sitting on that kind of data, that can double or triple or even more a share price, for a company like that. That kind of an intercept can be quite significant. I think that should be released. As soon as they get the data back, they do their QA, QC, they confirm that the numbers are good. Maybe they rerun some of those samples that were higher grade to ensure that they've got reliable data. You don't want to release data you have any doubts about, of course. But I think that should go out right away. I wouldn't wait for the 10th hole to get assays back. That kind of information can leak. It can get out. You can see other activity on the share price in the interim as somebody's whispering about, hey, did you hear? Somebody's got to do that. You don't want to see that happen. I think those numbers should get out right away. If it's Anglo Gold,
and you don't want. Sorry, but are you required to? I mean, at what point is there anything from the exchange? I don't know this. I mean, but you as a person who's written press releases for a reporting issuer,
yeah.
At what point are you required to release material results?
Well, I guess I've always felt that if you had something like that you were sure was going to move the stock in a material way, it was material information. If you get intervals back of 0.2 of a gram over 20 meters, well, that's interesting. It could be of importance down the road, but it may not have the same major impact on your share price that a higher grade intercept would in a different setting. I guess if you're concerned about it, you probably ought to just go ahead and release the data.
Okay. Brent, any thoughts on this?
No, Ron knows more about this than I do in terms of reporting requirements. But I think, as a tip to people still listening here and watching, check to see if that is actually a new drill hole or if they're re-drilling a spectacular hole from 10 years ago. Always look to see if there are historical drill holes nearby. And I always find it sort of ironic that when a company goes in and they go in to verify previous drill holes from another company over, whenever that was done, they're always checking the best holes to see if they're correct, where that was not the problem. The problem was all the other shit holes that didn't come up with anything. They never really re-drilled those.
Yeah, I gotta say, I don't want to name names, but it seems to me that maybe 8 times out of 10, a twin is disclosed somewhere down at the bottom of the press release, or at least in the last half after most of your retail investors have stopped reading. Maybe 2 out of 10, I guess that's 1 out of 5, says we are twinning or confirming historic drilling and upfront. But it's in there, and I think it's relatively rare that they actually don't mention it at all. You only find out later that this was in fact drilling where they knew they would hit. But I have seen that too. I feel as a public service announcement, maybe I should say names, but I don't want to get sued. Brent, have you ever been sued? Like, I've seen you talk and put up a slide that says how not to build a mine, or the type of deposit you don't want to find, right? The inverse of a pit shape or something like that. And the company is right there at the show you put the slide up at.
I've been threatened to be sued by a couple of companies. But in the end, it's just an opinion. People pay me for an opinion. That's my opinion. Take it how you like it. And I'll tell you what I do notice is the legitimate companies, they will come back to you and explain to you why I'm wrong. What am I missing? And I appreciate that. That's legitimate company will do.
Fair enough. Okay. All right. Questions in advance. Let's see. This is sort of like the PEA, PFS, BFS question, but resources. Inferred, measured and indicated, proven and probable. We understand that we have higher, scientifically estimated confidence intervals here. But how much weight do you put on these different categories? And does an inferred resource mean anything to you at all, Brent? Or is there a correct inferred discount that you might apply? Or how do you deal with the different levels of confidence in the different resource categories?
To me, it really comes down to what type of deposit it is. I mean, if you're looking at a big disseminated porphyry copper deposit, and you can see continuity and you understand the geology, inferred goes a long way. But if I'm looking at an erratic, skinny vein somewhere, I put a lot more question on the inferred. So it really comes down to the type of deposit for me.
Okay. The reader asked, is there a specific percentage, like a 30% discount for inferred? I know my answer to that, but
no, I don't do that.
Yeah, me neither. Ron, any thoughts on weight to be placed on the different resource categories?
Well, I'm not too big on inferred. I think it just indicates to me that there's probably some potential, because even an inferred number has to have some basis for it, whether it's trenching or a drill hole that's off by itself in a new area and it's too far away from prior holes to have any direct continuity and connectivity. Let's say. Certainly measured and indicated. You don't usually see too much measured resource early in a project's life. That should come. You want to be doing more, not long step outs, but you're trying to grow the resource. You're trying to see if the deposit has any size to warrant continuing work on the project. And usually that's not going to yield more than maybe indicated resource at that stage, but that's pretty good. You'll get to measured when you go back in later. If you have to come up with a good reserve estimate, you'll add infill holes to get the spacing down to that which would be indicated by the geostatistics for something that would be measured or indicated. And inferred, that's just kind of blue sky on the end of it.
I have a fishing metaphor for this. Imagine you're fishing in the boat there in the pond, and if you've got the fish on the line, you're just about to put the net on it. You're building the mine, right? You can see how big it is. You can say, "Wow, look, that's a 24-inch trout," or whatever it is, right? That's my proven and probable. The line can still snap. You might not get anything. Measured and indicated is more like, okay, we've been fishing for a while here. We've seen a bunch of fish. They seem to be about this big, and maybe we'll get one like that. Whereas inferred is, okay, we've got a boat. We've got some water. I think there might be fish here. Oh, maybe I'm being too harsh, but anyway, all right. So once bitten, twice shy, not by the fish. We have a couple questions here specifically for Brent, and specifically about evaluating particular companies' deposits. I'm not sure I want to go there. That's partly, it's partly, the idea here is to answer geology questions and not to give investment advice. So I'm a little reluctant to do that. Let's see. Maybe I'll come back to those if we get bored.
You're saving me from making more enemies.
Well, I noticed when you get those the expert segments out there, you don't pull your punches. I've thought about maybe doing or seeing if they would invite me to do one of those segments, because I'm not afraid to say what I think. But that's the whole idea of my take service, where I have clients who pay me for an unvarnished opinion on XYZ company. Now some 360 of them. So I don't know. It might be good advertising, but it just doesn't feel right somehow to sort of give away the goods for people who've paid. Maybe while I'm looking for the next question, Brent, I've noticed that you do sometimes give away picks in the newsletter. And I know we used to do that back in the Casey research days. How do you feel about that? I mean, do you...
Yeah, all right. So, I mean, at first, it's Exploration Insights is now written, owned, and run by Joe Mazumdar, who has been doing this for a number of years. he's a really smart guy. I met him on a project in Nevada, and took me 2 years to bring him on to convince him that, you know, newsletter rising wasn't as sleazy as it's made out to be. In terms of, you know, giving out picks, my view has always been that, okay, here's a stock we're buying, and it's what, you know, we're actually spending our money on, Joe and I, or Joe now, and here's the reason. It goes out in the letter. Once I feel subscribers have had enough time to accumulate it, then I don't mind giving out information like that. I mean, how do you and I actually, you know, promote ourselves without going down the slippery slope of many people? And to me, it's giving. This is what we think. This is why we think it. This is something we bought. And with a junior exploration company, it's really just as important to know when we sell, right? I mean, a lot of people say, "Oh, I bought this because you recommended it on BNN and I lost money." Yeah, well, that's because you didn't subscribe to the letter, and our theses changed when the metallurgy came back and we sold. You know, so that's my opinion.
Okay, all right. Ron, you're not a letter writer, so I'll leave you off the hook on that one. The next question we have from the live audience is about value per ounce. They ask specifically enterprise value per ounce. I used to do numbers on this. We used to publish numbers back in my Casey research days. We would look for all the inferred gold resources, for example, we could find, and find the average dollar per inferred ounce of all the companies we could find like that. We look for M&I, we look for P&P, and there were some interesting patterns there. There's a huge amount of work. There's no computer program that can do this because the companies report them differently. You know, there isn't a robot that can do this yet. So I'm not doing this now. And the patterns changed with market appetite. It was kind of an interesting exercise. But back to the reader's question, is there any kind of correct ratio if somebody has inferred how much value per ounce inferred do you think is reasonable, or makes something look undervalued versus M&I versus P&P? Do you look at that, and is that a good measure? You're on screen, Brent, so thoughts?
I think that's a real poor measure. It's an easy one. You see a number of companies that show that their ounces are being valued at $5 an ounce and their peers are being valued at $50 an ounce, say. Well, there's probably a reason for that. Their ounces are probably worth negative something if you actually figured out what they're worth. So I think it's an interesting number, but without the context of the cost to actually produce it, it's sort of, you know, it's meaningless.
All right. Ron, do you have any thoughts to add on that?
Well, I think just building on what Brent just said, reporting a bunch of ounces in the ground has absolutely no bearing on the economics whatsoever. And those ounces could never be economic and could never be produced. So what's their value? It's really zero to me. If you can't make any money on it, why are you going to spend any time? So it's a slippery slope. It's a difficult thing to really seriously look at and put weight on, unless you have a lot more information and better understanding about those ounces that they're talking about.
I quite agree. I've written that until you have credible feasibility numbers, you really don't have value. You have hopeful dirt. And I leave it at that. But from back in the day, I can say the interesting pattern was that in a more bullish market environment, when markets were frothy, you would see inferred ounces overtake M&I, and M&I catch up with P&P. I don't think either ever overtook P&P, but it was really interesting. I mean, it was almost a measure of market frothiness, and on that basis, maybe it's useful. And then when things were bearish and nobody cared, everybody hated gold yen or whatever, you could see that you know, inferred would go way back down, right? That optimism would flood away, and inferred was treated more appropriately, I think.
Well, I think this is, you know, we're talking about the option value of ounces in the ground, and that is a legitimate way to make money on a stock play. Is when the gold price goes up, these ounces in the ground are often touted as becoming economic. And if that's the way you want to play it, I mean, Joe and I, we don't play those things. We're aware of them, don't play them. But if that's the way someone wants to play it, the first place I would go to look after seeing how many ounces they got is how much money they're spending on promotion.
Yeah. I mean, I think another value perhaps of inferred, if there's a value for it though, I always will look at a property from the standpoint of endowment and just see do you see a lot of smoke in the ground? Do you see a lot of low grade assays that are telling you something, maybe suggesting that there could be something bigger hanging out here at depth someplace that we just haven't seen yet? And you have to be careful with that because you can drill till you're blue in the face and may never find anything. You've got to put it into the context again of an economic model or a geologic model rather. But it can be a helpful tool in guiding early stage exploration if you're seeing subgrade material, low grade material that maybe is above cutoff grade, but 0.3 of a gram or quarter of a gram that is a cutoff these days for a lot of operations. In fact, even less than that. That might tell you something that might help your exploration going forward. Just have to use it carefully.
All right, fair enough. And I don't know if we have a question on land bank plays, optionality plays, but I've noted Brent's take on that in numerous things. And it's maybe one of these ones related to the earlier question about when experts disagree, because we've got Rick Rule out there and others who talk about how great optionality plays can be. And I remember early on, I think it was Vista back in 2004. It was pure land bank play, and then gold went up, and that was a 10 bagger as I recall, before it evolved and allied and all these other adventures happened. So I have seen land bank plays deliver spectacular hockey sticks, but that's completely in contradiction to the Brent Cook and Joe Mzunga thesis of we invest in things we believe can be mines. So Brent, are you leaving money on the table there?
Yes.
Okay, fair enough. For what it's worth, me too. I just have a hard time putting my money into something I don't think will ever be a mine.
Yeah, I hate being embarrassed by it. I hate the embarrassment of owning something that I really don't believe in. It's just not worth it.
Well, maybe it goes to the Doug Caseyism of you can't kiss all the girls. Why do I need to speculate on that when there are other things that I think have a real chance of creating wealth for everybody? All right, so next question from live audience participant. Which is more important, all-in sustaining cost or payback? Well, we didn't even have all-in sustaining cost before a few years ago, but it's quite the number these days. I'm not sure why the questioner asked these particular two variables, but it's an interesting question. So Brent, you're on camera. Thoughts? What is there one of those you would look at or put more weight on?
Yeah, I've never thought of it that way. So I'll leave this one for Ron.
Well, I guess you have to define what's the basis for defining payback. If it's just a very crude number that in 3 years I'll get my $180 million back, from this project in cash flow, I guess that might imply a fairly low all-in sustaining cost because you're getting your money back, quicker. But there are a lot of assumptions in what goes in those numbers. We all know what I think all-in sustaining cost is and cash cost at a mine site. Payback, not sure is a number I could accurately put. What really are you throwing into that? What's your measure for that?
All right. Well, I'll jump in with a little bit more because I think all-in sustaining cost, AISC. I think it's in the first place it's a bad name. It's not all in. Doesn't include taxes. Doesn't include a bunch of things. I understand why the industry took it up because cash costs seem to make it look like they're making all this money, and the politicians were saying, "Oh, we're going to tax you more. You're making so much money." And like, "Oh, wait a minute. Look at our all-in costs. We're not actually making that much money. Please don't kill our mines." So I understand the reason for it, but it's not really all in. Or else you'll see companies that'll report interesting all-in sustaining costs, and they still have a net loss on the bottom line. So it's not all in. So that's the first thing, is keep that in mind. The other thing about payback is I would add a variable here. Payback is important, of course, but the if you have a land bank play, we were just talking about optionality. If you have anything that's higher risk, then a short payback, I think, becomes more important. Right? If you need really high gold prices, if you've got, oh, I don't know, say Alive and Good, ITH, not to pick on anybody, but if you have, that's the one that comes to mind. It has a fully bankable feasibility study that proves that their mine won't make money at less than $2,000 an ounce, right? So if you've proven that you need $2,000 an ounce, and then woohoo, gold goes up to $2,000 an ounce, great. But then it's back down again, right? So suddenly, you're out of business again. So if you have something like that, where, higher price is great, this might work, the shorter the payback, the better the chances that, you'll have an actual mine that works if it turns out that the current high prices don't last. So perhaps what I'm saying is just, depending on the environment, in a currently high price environment, on a sort of more questionable or risky proposition, then I want a very short payback.
Sure.
Any thoughts or comments while I look for the next question, or well? All right, we have chatter here, so I'm going right through. All right. Okay. What are the differences or significant differences that investors should be aware of between the Canadian 43-101 national instrument and, say, Australian JORC rules? And I know the questioner doesn't ask about US, because in the US, unless you've got P&P, you've got nothing. So perhaps that's why they ask for that contrast. But any thoughts on that? Ron, you're on screen.
Well, I'm not sure I can really comment on the intricacies of JORC standards. I haven't worked in those. I've spent some time in Australia, but not enough to be familiar enough with the terminologies. I guess I could say with regard to 43-101 is as much of an improvement as it appeared to be many years ago. You still have to read those carefully. You have to look at the data in them and make sure you're comfortable with what's in there. They're not all written as well as others. So.
All right, Brent, I know you spend a fair amount of time kicking rocks down under. Any thoughts on JORC versus 43-101?
Not really.
All right. Well, how about this then? You know how my friend Doug Casey likes to call the SEC the Swindlers Encouragement Commission, because it makes, there's a regulator there. There's somebody watching over things and making sure everything's okay. And so it's safe to invest, is the message. And he thinks that's very dangerous, because it's never safe to invest. People always game the system, play with the rules, and you can swindle now. I don't think there are any fewer swindlers now than there were before, and maybe they've been encouraged. I wonder that about the 43-101 regs. You can make all kinds of assumptions that go in there. Maybe you get an optimistic engineer to sign off on something. I've seen some things signed off on that I just, my jaw drops. So is 43-101 or any of these, oversight sets of rules, do they really help, or maybe do they lead the lambs to the slaughter? Any thoughts on that, Brent?
I think anything that gets you more information is helpful. You've always got to interpret it, and make your own decisions based on the data. But certainly anything that gets you more information is helpful.
Okay. Ron, I would predict you're going to agree with that, but any other thoughts to add?
No, I would agree. As I just mentioned, I think we know there's a wide range of people that are preparing 43-101 reports for early stage projects through late stage projects. And there is data that you can glean from those that could be of interest to you, that could be helpful on another project, something else you're working on. But you just have to look at them with a careful eye and take it with that. So.
Okay. All right. So the next question we have from the live audience is, they ask if you have a favorite valuation metric for a mining company or project. I know that, that's tough to pick one, but maybe are there 1, 2, or 3, or what are the top evaluation metrics you might look at when evaluating a project or a company? Well, you're on screen, Ron, so if you have.
You'll nail me. Well, my role in life hasn't been so much to evaluate other companies based on what they're producing, but I guess if I were looking personally at a company to invest in and they were a producer, I'd certainly be keen on grade of their deposit, on the economics associated with that, to get a measure of their profitability at not maybe at necessarily current gold price, but at a long-term price that they might sustain over the course of time, so that they're not going to be in that at the top of the fourth quartile in terms of cost, that they're going to be a producer that's going to be maybe middle of the range anyway, maybe at the top of the second quartile, so that they can sustain themselves over the long term. High cost companies are of course exposed. Price of gold slips and goes down, they can fall from profitability to neutral or negative ranges pretty easily. But if you have an operating structure that puts you in the middle of the pack, you have a better chance to sustain over the long term, which might be a better indicator for a company to invest in.
All right. Brent, any favored metrics when you evaluate companies or did evaluate companies?
I still do, but Joe does all the hard work. I just, but I think really what we're after is, does the project as presented offer the potential of a significant enough deposit that a major mining company is going to come in and buy it? That's really what our end goal is. And that seems really simple, but I would say, I don't know, 70% of the companies and projects I look at, even if they're successful, given the risks involved, it's not worth the effort. Too many people, too many companies are out there looking at projects that just don't have the potential to be of any real value. When you throw in the cost it's going to take and the dilution you're going to take to prove you've got a so-so deposit.
I won't disagree with that, but I would disagree with the binary way you've presented it. Either it's good enough to interest a major or you've got nothing. I think there's clearly ground for somewhere in between for somebody to become a new producer, then a new mid-tier, then a new major. We've seen that happen this cycle.
Yeah, certainly. But again, the thing comes down, if you don't have a great project, unless you're in a really bull market, my experience has been that the market cap may go up, but the share price doesn't.
Yeah, no, I get that. If for anybody who doesn't immediately jump on that, you have a great sounding, or maybe even a really exciting project, legitimately exciting, but you got to explore it. You got to define it. Now that costs money. You're going to issue shares, and the market cap can go from 50 million, 100 million, $500 million, but the share price goes nowhere as you're issuing paper to get all that work done. I understand.
Let me give you an example of something I did just the other day. A company I was looking at, they, in theory, if they're successful, they'll drill off, I assume, a 5-meter wide vein, averaging about 10 grams a ton, and they're hitting it in the order of, on average, 400 meters depth. To drill that off, just to infer, assuming 50 meter centers, is going to take about 450 drill holes to bring it to 1 million ounces at 10 grams. At $150 a meter drill cost, core drill cost at this location, that's $26 million they've got to raise to get it to inferred, assuming that vein is consistent through the whole thing. I thought that was an interesting finding there.
That's a good number, and that's not an assumption I would ever want to make. All right. Ron, anything you want to add to that, or next question?
No, I'm fine. Go ahead.
I need to plug in my computer here. Hang on. Just keep going with that one.
Go ahead. Yeah. And so, by the way, to either of you, we've been going for a bit over an hour now. If you have to go, I'll keep going until my voice runs out. But you're not stuck here. I appreciate your time and your thoughts for, as long as you care to share them. We still have a few more questions though. So if you have more energy and you're okay with that, we'll keep powering ahead. All right. So the question here, the next question is about re-rating of the market re-rates, market response and share price to resource categories. Like if you have nothing and then suddenly you have an inferred resource, you know, for all that we've been poo-pooing inferred resources, at least you have a number there, right? But then you go to indicated or measured and indicated. You know, does the market tend to reward that with share price? Does the market care that now it's measured and indicated, or do they only care when it's proven and probable? Or do they care when it's proven and probable? And how much more do they care for proven and probable than measured and indicated? Do you have any thoughts on that, Ron?
Well, obviously proven and probable, measured and indicated are, well, measured and indicated would be economic ore. And that's the most important category that we have. That's stuff that's going to get mined and going to make money. If it's, but in an early stage project, you're not going to get there very quick. That's going to come toward the end of the process, in theory. I wouldn't want to be drilling out, starting right away, drilling out a property adequately for proven and probable, because I don't know what the economics are going to be. I don't know what the ultimate size is going to be. So your drill strategy should be to be doing a little bit longer step outs and not trying to get, again, drill hole spacings that are going to be adequate for that type of categorization. But it would seem like as you advance and get to that point for a junior company, it should, the ounces in the ground should be worth more. So.
All right. Well, I'm not sure Brent's back, so I'm going to jump in and say this is old data at different gold price environments. So the numbers don't matter, but maybe the ratios matter. I mentioned before that back in my Casey days, I used to have my helpers help me pull through all the public company data we can to lump as many like purely inferred resources into one aggregate category, M&I and P&P. And we found, I remember at one point in the mid-aughts, it was something on the order of like $15 to $20 per ounce inferred, around $25, $30 per ounce M&I, and over $100 per ounce P&P. So that was obviously at a very different gold price environment, different time, different place. But what I'm saying is, for whatever it's worth, you know, that there was a bump up, a significant bump up from inferred to M&I, and there was a huge bump up to P&P. Now, most of the P&P was in producers, you know, so you had bigger companies, larger investment pools, seen as less risky. You had, you know, book value and asset values that institutions could wrap their minds about. So it's completely unsurprising to me that and I do not remember these numbers, so please don't write these numbers down. That's sort of like conceptually how I remember them being like. Though I do remember that P&P was over 100, and M&I and inferred were not. But what I'm saying is that there was a distinct pattern, and there was a bump up from inferred to M&I. Except in a very frothy market when inferred overtook M&I, and P&P was always more and significantly more, and that makes sense to me. Brent, are you back, and do you have any thoughts on share prices reflecting re-rates from higher resource categories?
No, I think you covered it. Regards your earlier question about having to take off, I've got a takeoff for volleyball in about 15 minutes.
All right. Okay.
Ron's probably got to go golfing somewhere.
Yeah.
All right. Well, let's see. Well, let's try to briefly go through. There aren't that many questions left. Let's see how many we can get to. Either of you, are there any particular geologists out there that you respect, that you read? Who gets your attention? Might you recommend to the audience? And you don't even have to say me, because I'm not a geologist. You're off the hook on that one. You don't have to be nice to me.
That's tough. There's a lot of good geologists out there doing good work in both major companies and junior companies. So I mean, yeah, there's a lot. I communicate a lot with a good friend of mine, Doug Kerwin, who he and I used to work in Australia and New Guinea together. Quentin Henning is another guy that I communicate with a lot and have a lot of respect for. Steve Nano used to run Mirasol. He's over in Australia again. But there's a lot of good people out there. And you know, I want to make a point here that there's a lot of good companies doing good work. I tend to sometimes crap on some. but there's good work being done out there too.
Well, if there's what 1,500 juniors listed in Canada, and 90% of them are crap, that means there's 150 companies out there doing good work.
Yeah.
Actually, I'm seeing now that the question was specifically towards energy evaluation. Do you know anybody in the oil patch, Brent, that you think highly of? And it may not be a geologist in the field. It could be a newsletter writer who actually was a geologist like you, or.
Not really. I mean, I think I communicate with Matt Battiali, who used to write an energy letter for, I think, Stansbury. He's a good guy, but I don't follow energy that much.
Okay. All right, Ron, any energy geologists that are writing for the public that you know of?
No, there's nobody I could come up with. I know Matt as well, and thought a lot of him, but I haven't seen him for a while. I'm not even sure what he's up to at the present time, to be honest.
Okay. All right. Well, let's move right along. We have comments here. I have to scan past. Sorry. Any recommendations? This is actually one I get a lot. Is there any book that you would recommend on economic geology for resource investors? Something people can find on Amazon.
Oh, shoot. We used to have one linked from our website, Exploration Insights, and I don't know if it's still there or not. I think the guy's name was Stevenson, but I can't, right off the top of my head, I can't recall.
Didn't PDAC come out with a kind of exploration simplified or mining simplified book a number of years ago?
Yeah.
I think I recall. I think that was written more for an investor rather than a professional person. Be good to see. All
right. Well, let me see if I can get another question in here. I have a technical issue to attend to here. Let's see. Harry Gant, comment, best books.
So are we getting positive or negative comments there, Louis?
There are a lot of thank yous, but I'm trying to get to the questions before we run out of time.
All right.
Here's one. For someone interested in returning to school to pursue an MSc or PhD in geology or geophysics, what are the most important current research topics that are relevant to the mining industry?
I don't know. Nothing changes.
Nothing changes. I'm trying to get my power supply here to work. I may lose energy in my backup battery. Ron, any thoughts on that?
Well, certainly getting an MS, I think, in economic geology, geophysics, although in some senses hasn't changed a lot, it has. And I think, certainly getting a good course in exploration techniques, geophysical exploration techniques would be good. I had an undergraduate degree in geochemistry. I think some coursework in geochemistry would be good. I mean, the fundamental nuts and bolts that you're going to use if you're out in industry trying to explore and find things. And those are still pretty important nuts and bolts, I think. Maybe satellite imagery, some people snare at it. I'm one that thinks there's a value there in certain environments that where it can be pretty darn helpful. At least having a fundamental understanding of what it is, how it works, what it's telling you could be helpful. It has for me.
Sort of somewhat related question. Is there any advice you would give a new qualified master's degree geologist in what direction area of world or sector should he look for the best jobs or areas to avoid? Ron, you're on screen, so if you have any thoughts on that.
Areas, you mean geographic areas? Or?
It looks like they're asking both geographically and I guess minerals, like sectors. I assume that means type of mineral exploration.
Well, I've always thought that new grads who got out and went to work for some of the larger companies, if they could get a job with them, would get some really good experience. A lot of those companies, at least in the past, did more in the way of training and preparation, trying to build, professional in the business. College degrees help you; they give you the nuts and bolts. But getting out and working, you really start to add to your education. And then, if that goes well, you could stay with that. I think for me, it was a bit of large company work for many years, and that really helped me. I think when I turned to the junior market and got involved in that part of the business, a lot of what I had done for large companies was helpful and beneficial, particularly on the administrative side.
Brent, any thoughts to add on that?
Not specifically. I think, on an individual basis, it's look down the road 10 years and decide what you want to be doing and work towards that.
Okay. We seem to have, it's interesting, a number of different geologists are out there in the audience. And a sort of related question was, sorry, I've lost my cursor here. Is there currently an undersupply or oversupply of geologists available to the mining industry specifically? And do you see that changing in the near term?
My understanding right now is there's a serious undersupply of younger geologists to come in and take the place of people like me and Ron. There's a big gap during the various busts periods. Everybody gets fired and nobody comes back in. And so in the age group, I would say, in the 40s, 30s, 40s, and 50s, there's a big gap of people that don't, there's a need for people to experience. It's not being filled. And I guess the second thing is, it used to be, you're a geologist, you'd expect to spend 6 weeks out in the Yukon or New Guinea working, separated from all your friends and family. And now the idea of doing that to a lot of younger people and being without Facebook or Instagram.
Well, but wait a minute. I mean, you do have satellites now, and I've seen camps in remote areas where people have internet and stuff. Could it be easier? Could the divorce rate go down amongst geologists as the world becomes more interconnected?
That's outside of my field of experience.
Ron, any thoughts on this? Are we still facing a geologist shortage, and is it getting any better?
Well, I mean, an important point Brent made was that when prices are up and the industry is active, you don't have anywhere near enough people. And as soon as the price of gold falls back to 1,100 or 1,200, we'll be at the opposite end of the spectrum where we're really hard as an industry. We're really hard on geologists. I mean, they're the first ones to go. It seems like in the larger companies, they keep their metallurgists, they keep their engineers by and large. But you cut exploration. If times get tough, you're going to knock your budgets in half or worse, and that means you're not going to need as many geologists. So we're a little bit hard on the industry, kind of getting to your point about what Brent's about remote locations and time with family and that.
All right.
Right now, I think the younger people are the hard ones to find, and we had an issue a few years ago. There's too many senior geologists, and we wanted to get young blood, new educations, younger guys that have had the coursework I referenced earlier about the new skills, particularly software, modeling software, geologic modeling software. I can go into one of the guys' offices in our company, and he doesn't have any maps on the wall. Everything he does is in that monitor that he's got in front of him, and getting very capable with using that kind of software. Exploration related geologic software is, I think, a very important skill set. And you're not going to find that in probably, in the 50-year-old plus guys. You're gonna need the 25 to 35-year-old group coming in, and those guys are in demand. They're hard to get.
A mix would be good. I just quickly want to say, when I first started in this business and I went out in the field, it seemed to me that everybody had gray hair or no hair. And now I go out and I see a mix. There's fewer gray hairs. There's some, shiny black hairs out there. And it's good to see new blood coming in, getting experience and so on. But it worries me, especially the next downturn. Who knows what happens if more of the gray hairs and no hairs go away and don't come back. Do these younger bucks have the experience? When they're suddenly chief geologist or VP exploration, but they've only got 10 years under their belt. You don't need to answer that, but it's something that I think about. If I go out in the field and I see no gray hairs or no hairs, all young bucks, that would not be a positive in my little black book of sins. Brent, I know you got to go. So just real quick, last question maybe for you. We have questions about PGMs and nickel plus deposits. Are there any particular things that you look for in this space, or red flags? I mean, I know it's one of these can of worm type questions, but what do you look for in good nickel PGM projects?
It's same thing as with any project. It comes down to, grade, costs, location, that sort of thing. Joe and I evaluate them all on the same basis. I mean, we own 2 nickel PGM companies. One's Australian Blackstone in Vietnam. And what we like about that is, in our evaluation is the nickel that will be produced is a sulfide that can be used directly into batteries. So we want something that, we can see the end product is what someone's going to want. So again,
that was actually part of the question, so are there deposit types that are better, your laterites or whatever?
Laterites, to my understanding, don't produce the high grade sulfide nickel that are needed for nickel batteries. So we would avoid a laterite nickel deposit.
Okay. All right. Well, I think you're going to have to go before your glass slipper falls off. Thank you so very much for staying with us. We'll give you a link that you can share with anybody you like, and I will continue on with Ron until he has to go. And then if little old me can help answer anything that's left, then I'll go on till my voice gives out. Thank you, Brent. Have fun out there and take care.
Thanks. Appreciate it, Louis, and we'll see you somewhere, Ron.
Somewhere when we can travel again. All righty. Ron, any thoughts that you'd like to share on nickel PGMs? And actually cobalt was mentioned as well.
No, not really. Those are not plentiful in Nevada, where I've spent most of my time. No nickel mines here. There are a few prospects for nickel in a couple of locations, but to my knowledge, they're not too exciting.
Actually, let me stop and highlight this answer. That is a fantastic answer, dear audience. Basically, Ron just said, no, I don't know. And he's one of the most experienced geologists I know. That's why I invited him here. I think that's awesome. And it's not just Ron's a great guy and he's honest, but this is important. When you're looking at a company, this is something I learned from Rick early on, and it's served me really well. He wants to know, as Doug, people are the first P of resource stock evaluation. People are crucial. And you're not just looking for people with a fancy long resume with lots of credentials and fancy, big companies or whatever. He wants to see that the team, and especially the geologist, has experience on the type of deposit that this company is looking to explore, the kind of discovery they're trying to make. And Ron is basically a gold silver guy in Nevada, or more broadly, a Nevada guy. So to have Ron comment on laterites in Australia or Brazil or something, I'm sure he could say something that would sound intelligent, but the best thing is to say that's not my expertise. And kudos to that, to you for that, Ron. And word to the wise in the audience out there, I think this is really important. When you're looking over that first P, when you're looking over the track records of the management team, if the management team is 2 guys and they're both accountants, that's not necessarily the team I want to see in an early stage exploration play. And I'll leave it at that. Ron, so you just tell me when you need to go, and we'll see what else we can get to here.
Well, I'm good for a few more questions, and I'll take off.
All right. Some of these are repeats. I would say, like, somebody has asked about drill results and grades over meters. We actually discussed this earlier. So when I post this, never done it this way before, but it is my intention to post timestamps where you can go directly to specific questions and their answers. So that one, how good is a meter of a gram or whatever, that has been addressed. And we'll see what we can do to steer you right there. So Ron, are there any new technologies or techniques that are changing the exploration game? I remember being very deeply impressed when the Niton gun came out, so easily portable. And you could shoot a bag of RC chips. And if you had something that correlated with the gold, or if you're looking for copper or high grade nickel or something, you knew right away, right? You didn't have to send to the assay lab to know when to turn off the drill rig or something. So that's just one example I can think of. Do you see that the industry is changing significantly, and does that help, or how much does that help? Does it matter? What does that do for the resource investor out there?
Well, I think tools like that are very helpful. They don't have the ability to directly report gold or silver, usually in the grade ranges that we're dealing with. I think now they're below 100 parts per million, generally speaking, which is about 3 ounces of silver, but you rarely get a gold number that's going to get picked up, obviously. If it's got to be 50, 60, 80 ppm or grams per ton, that doesn't happen. But as you said, you get arsenic numbers, antimony numbers, others that can correlate with gold, and it might help you on a drill site to know that you're in a zone of high arsenic. You know from other drill results that gold you're finding is accompanied by anomalous amounts of arsenic. So they can be helpful, and they've been a big boom. That's been one of the more archaic things that I think we as an industry, have to live with these days. Is be on a drill site and get samples in white bags, and then have a pickup truck haul them into town 4 or 5 hours away.
It's 100-year-old technology.
Or ship them around the world. I mean, I know a company that's having the pulps from a lab in Elko being shipped to Mexico to get analytic work done because the labs are so busy, right now in Nevada. We need something that's better. We need something that's real time at a drill site that can give you the kind of results that I know an investor would like to see. At the end of the day, you know what's in the drill hole. We're not there yet. And,
sorry, Ron, just follow on that. Do you think is there potential here to impact supply? Like, you hear about peak gold, right? Or the big easy copper deposits have all been found. Is any of the new technology, developments in satellite imagery that I know that you use that tool, does that address that? Or are we really supply constrained going forward, and the new technology wouldn't help much?
Well, related, I've never believed in peak oil. I remember the book from in the early 70s, Peak Oil, and how we were running out of oil. We'd never produce as much as we had in the past, and lo and behold, we are. It's all a question of economics. It's a question of money, and if there's enough money being thrown at gold exploration around the world, I think the amount of gold produced, can increase on a global basis if that's what we needed to do.
All right. Somebody asked about BIOX processing, and Brent's no longer with us to address that, but do you have any experience with BIOX processing, and is there any comments about it you want to make?
Really pretty limited. There's been an attempt in the past, I believe by Newmont, to do bio-oxidation on heap leach ores in the Carlin area. They did it for a while. It was more of an experimental approach. I mean, technically it worked, but they're not doing it now. So it must suggest to me that the economics, just weren't right for them, or there must have been something else about it they didn't like. Milling approaches are used in, I believe, in South Africa on higher grade concentrates, sulfide concentrates, which they can bio-leach. There was an attempt in Nevada in the mid 80s for a milling approach, putting ground ore into tanks, letting the bugs bio-oxidize it. And one of the interesting problems was that process is exothermic. It creates a lot of heat. And if you don't have a way to cool the vats that you're doing that bio-oxidation in, you reach a certain temperature and you kill the bugs. So that's got to be controlled. And apparently it is in South Africa. You can put water jackets on the tanks to keep them cool. But so far, I haven't seen it as a process that's been adopted here, certainly in Nevada, which is one of the bigger gold regions, of course, in the world.
Well, I will throw in that, one of the most famous, at least amongst resource speculators in the junior space, gold mines in the world today is Fosterville in Australia. And Fosterville has a BIOX circuit. And I remember exactly the issues you're talking about. You walk over the tanks, they're covered in black goo and they stink and they're hot. And cooling is a cost. But if you've got Fosterville, you can deal with a lot of costs. Wow, what a deposit. From BIOX to Bitcoin, this is not really a geology question, but and Brent's no longer with us, but Ron, would you ever speculate on Bitcoin? Do you own any?
I do not own any Bitcoin. I've been a bit naively puzzled by it, how the value is there in the long term. I wouldn't discourage anybody from investing in it. In fact, one of the newsletters I'm getting, that's one of the things they're talking about is that you really need to have a certain amount of Bitcoin in your portfolio to deal with the crises that are coming down the road for us from a governmental point of view. I do own some gold, not a lot to save my life. If things got really bad, but certainly would consider more, and gold equities. I think I own a number of different companies that I've done okay with, that have come from people like you in terms of recommendations that have worked out okay. But Bitcoin hasn't been one that I've jumped on yet. Maybe I will, but not sure.
Alrighty. Personally, I don't own any Bitcoin. I do have some Ethereum. I put some play money into. My general view is I'm a libertarian. I think free markets are the best solution for most problems and situations in society. And I think free market money would be great. Let the market decide. I don't have to prove or decide whether Bitcoin's better than Ethereum or gold or whatever. I'm happy to let the market decide. We'll see. So here's another can of worms question, but maybe there's a way to simplify it. We're asked to discuss the different types of ores. Is there a way to sort of broadly classify ores, oxides? What is Carlin type?
Well,
I know that's a book and a half that needs to be written. But is there an easy sort of rule of thumb or two that you could give resource investors out there for ore types, what to watch for?
Well, the vast majority of gold recovered in Nevada in the mining industry, and I think this is true probably worldwide, you use sodium cyanide as a lixiviant to recover the gold from ore. Some ores very easily recover gold. They're classed in a certain sense as oxide ores. They may not be an oxidized rock as you commonly think of an oxide ore. There can be ores that are primary, but the gold is in elemental state in the ore itself, so that it recovers with cyanide quite readily. So these classifications of oxide versus sulfide are generally made based on whether or not the gold in that material is recoverable using cyanide, directly and easily. In the case of refractory ores, there are a number of different types of refractory ores that are out there. You'll see a report that the testing was done and the ores turned out to be refractory. Well, the common thought is that the gold is on an atomic scale. The atoms of gold are disseminated in a grain of sulfide, pyrite. That's a good example of a refractory ore. It could be that there's a lot of carbon, active carbon in the ore, like there is with Carlin type deposits, and that carbon is actually preg robbing, meaning that if you have gold in ore and you have cyanide solution, the cyanide extracts the gold from, let's say, its current host, but then you have this carbon floating around, and when those atoms of gold in the cyanide reach and come in contact with carbon, it strips the gold out of the cyanide complex into the carbon, and you can't recover it. There are also cases where gold is tied up in a very silicified rock, massive quartz or some other material. That was a problem at Eskay Creek, for instance. And you just can't get liberation. The gold grains are very small. The rock is very impermeable because it's basically quartz. and you don't get interaction between the cyanide and the gold in those rocks unless you grind it so fine that the costs blow up to get it out. So a variety of different types of refractoriness in an ore. But if it's oxide, it just means that you can get it directly with cyanide.
All right.
Reasonable answer. Too long, too short.
No, well, but that's interesting. A lot of people think oxide versus fresh or sulfide. But what I'm hearing from you and in terms of trying to give something brief and useful is it's more important to concentrate on refractory versus non-refractory.
Yeah.
If 1 gram near surface oxide, easily recoverable would be maybe fine. But if it was refractory, if the gold was encased in pyrite, for example, or then maybe you need 3, 4, 5 grams to make that same thing work.
Yeah, I mean, 1 gram per ton of refractory material at the surface is probably not going to be economic. It depends maybe on the type of refractoriness you're dealing with, but that kind of material is very common with Carlin type deposits, which are important in Nevada. Probably 80% of the gold produced in Nevada comes from Carlin type systems where you have that kind of a problem. 1 gram per ton is probably not going to make it because the mining costs coupled with the refractory treating costs in a roaster or an autoclave, you're gonna chew up 2/3 of the value of the gold you might recover from that right there. The treating costs, I'm not sure if I'm current on them, but a roaster or an autoclave, you're looking at $30 at least a ton to treat that material.
And correct me if I'm wrong, but to the question, Carlin type, it's not necessarily it's not an ore. You can have a Carlin type system that has been oxidized or is still fresh. So it's not oxide versus Carlin type. Carlin type refers to the deposition and the microscopic nature of the gold in the deposit. Is that fair?
Yeah, that's the genetic model, and at least in my opinion, and other geologists have a different opinion at times. All the gold in a Carlin system is all deposited when it's formed in a sulfide environment or a primary environment that's refractory. The oxide deposits are ones that have gotten near enough to the surface where meteoric waters percolating through the rock have caused the pyrite to oxidize, rust, if you will, turn from iron sulfide to a variety of iron oxide products. But in the process, the gold atoms are freed from the sulfide lattice and they're recoverable with cyanide. But that's a supergene later process that happens, and it's not the primary mode of deposition. They're not deposited as oxide ores. They're deposited as sulfide ores, and then parts of it get oxidized by surface supergene processes.
All right. And, when we come to veins, that's a different deposition model, but you still can have the same situation where you have, well, you could have elemental deposits, but you tend to have fresh sulfide rock, which also then, if it gets, and it's not always meteoric water, as I understand, there can be other oxidizing agents that can liberate the gold. Is that right?
Well, waters percolate into the rock contains iron sulfides. The iron sulfides rust, if you will, or oxidize and form sulfuric acid. The sulfuric acid then perpetuates the process of leaching and dissolving the other pyrite or sulfides that are in the rock, and in that process, you free the gold. There are other types of deposits being mined in Nevada that are more variable in their metallurgical response. In some cases, they use flotation technology to collect the sulfide grains that contain the gold, and then there are different processes you can use, either a strong cyanide leach or possibly you autoclave treat material like that in its original state, you can't do it because the grades are too low, but once you make a float con, then it's economically treatable in a process like autoclaving or roasting.
All right. Are there specific sort of red flags in the mineral suite that you might look for? I remember Morgan Poliquin warning me about energite and some of these copper gold deposits, how difficult energite has proven to, for metallurgical purposes, to liberate the gold. Are there things like that you look for, or any others that you would caution people to keep an eye out for?
Yeah, I mean, enargite is a common mineral in the so-called high sulfidation style of gold deposit. Goldfield, Nevada is the best example here, but they're found in other locations too. And the enargite is a arsenic-bearing copper mineral, and it's nasty metallurgically, and it can be a real problem in processing ores from those kinds of environments. As far as others for gold, again, copper can be a problem. Copper is a cyanide, is an element that will be attached by the cyanide molecules in a process stream, and the cyanide will just get blinded because it'll absorb so much copper that it won't absorb any gold. So you want to keep copper out of these, out of the heap leach operations, out of the milling circuits in Carlin deposits, which is usually not a problem because commonly there's very little copper in a Carlin type system. There certainly is mercury, there's arsenic, and depending on the process approach you're taking, if you have to autoclave or roast those ores, obviously the mercury gets vaporized, it can go up the stack. You don't want to be spewing that into the atmosphere, so you have to put scrubbers in place to recover the mercury before you release it. The industry in Nevada has really developed that well. And two, the sulfide minerals, orpiment, realgar, most commonly, in a roaster, they get turned into oxides of arsenic, which are very mobile. And so as you operate those autoclaves, they're run in a fashion that they'll generate insoluble arsenic minerals rather than the oxides, so that when they get put into a tailings pond, they're inert. So you have to be prepared to deal with things like that in certain of the ores.
All right. Well, if you're good for one more, there's one here that I can't answer, at least as I read this. The question is, as an investor, are PCDs more profitable or high grade or low tonnage copper deposits or replacements, skarn, VMS? It seems like they're asking about a bunch of different deposit types, but I'm not sure what a PCD is. Do you know what they mean by that?
Porphyry copper deposit.
Oh, okay.
It's my
Porphyry
guess.
copper, I understand. So, so let me go back to the question then, unless you understand more. Right. So, right. Well, in a copper, it can be a copper gold, gold copper. Porphyries come in different styles and flavors.
Right.
I guess broadly speaking, would you rather discover a porphyry copper deposit or a skarn type deposit or a vein or a VMS lenses? What's your favorite deposit type, Ron?
Well, the favorite type for me would be Carlin type. And the reason being that they're very large. They can be very large. Not all are huge, but the discoveries that are still being made today they're not 1 and 2 million ounce discoveries. They're ones that are coming in at 3, 4, 5, 10. Barrick, for instance, now is talking about the 4 Mile and Gold Rush being a 20 million ounce system, and it's still open and growing. So they have the potential to be huge gold deposits. And if I'm exploring, I'd rather explore for those. They have long lives. They can have very good grades. The technology's there. The infrastructure is there. They're good things to find. Vein type systems, low sulfidation epithermal systems. Round Mountain is an example. It's kind of an end member of that style of deposit. The Comstock in Nevada was one of those. There have been a number of deposits found that are classed as these vein type occurrences, bullfrog, some of the new stuff going on in the Beatty district. If you look at a grade tonnage model for those systems, they're generally just not as big. They can be higher grade than Carlins sometimes, and that makes them attractive. The metallurgy can be a challenge depending on the mineral system. They're not all the same. You have to test all those carefully because they're different in their response. But generally, they're going to be underground. They're going to be hopefully better grade, high grade. I mean, everybody's seen the photos coming out of the Round Mountain deposit of the big chunks of free gold that's been found, and I think continues to be found there. But again, they're not going to be, with some exceptions, they're not going to be the 10 and 20 million ounce systems that you see in Carlin type deposits. Porphyry copper gold. obviously very big mineral systems. Permitting with copper environments always proves to be a little bit more difficult because of the concern for fisheries and things like that. But they're huge deposits. They're going to be large, low grade. They benefit from economics of scale because you can use all the biggest trucks and the biggest mills to get the processing and mining costs as low as possible because the grades are not generally as high. I'd rather look for Carlin type or low sulfidation epithermal as my favorite targets.
All righty. Well, I have one more question here that's not company specific. There's have you seen these reports of a giant platinum gold asteroid out there that's going to crash the price of gold? And the question is, how many years before
before it strikes?
Yes. Sorry, I shouldn't laugh. I mean,
yeah. Well, I think maybe that in part drives Elon Musk to get to space and to take a scanner that we use now on Earth and scan the meteorite belts in space to find the metalliferous asteroids. I mean, we know that the core of the Earth is metal, a lot of iron and probably other metals associated with it. Wouldn't be surprising if there are. We know there are metal-bearing meteorites that hit the Earth, as well as the stony ones, or two broad classes. I'm sure that there'll be some of that, but it's going to take a bit of time and some new technology, I think, before we can do that in an economical fashion. Maybe 100 years, I don't know. 50 years.
You're much more polite than I am. I may risk losing a reader here if this is a subscriber, but I'm just going to say, don't worry about this. I mean, we don't. We have just now got a robot that stuck out an arm and touched an asteroid. It's decades and decades before we ever get around to actually mining asteroids. And then, even then, it's called Psyche 16. It's not a giant platinum gold asteroid. It is a metal-rich asteroid. It's an asteroid that we've never touched, and the signals reflected back seem to indicate a higher than usual metal content. But even that is mostly nickel iron. And even that wouldn't mean that the thing is made out of nickel iron. It means it'll have more nickel and iron than your typical asteroid. And mixed in with that, you would expect some platinum, gold, other metals. And because it's rather large, if you do the math and you can say, oh, yeah, it's got, millions of tons of gold in it or whatever. But sorry, this is just a lot of hype. It is decades and decades away from being significant. And I think at some future time when our species is a spacefaring species, resources found out there are likely to stay out there. You'll be building spaceships and transfer points and colonies and stuff. And, it's expensive to send anything down a gravity well without crashing it. Much better to just use it out there. I would expect only manufactured products of high worth to be worth sending down the gravity well. I'm just absolutely not worried about this. And these ridiculous headlines you see about, $10 quadrillion worth of gold in this asteroid. Well, it's just not true. It is literally not true. And if you did have that much gold, it wouldn't be worth $10 trillion. So it's still not true. Sorry. Well, that's actually it for non-company specific questions. And you did say you had some other things to do. Ron, so let me give you the last word here. As a geologist, are there any key lessons that you wish resource investors would carry away? When you're talking to investors, what is it about geology that you wish they understood better and maybe was worth their time to study, or words of wisdom that you want to give us before you go?
Well, I've mentioned to you in the past, and I still think, this is all about economics. It's all about the dollars and cents and being able to mine something profitably and develop an economic venture. Whether it's Carlin type or low sulfidation or porphyry copper type, the issues are all a little different in terms of making those evaluations to come up with what the economics are. But if it takes, you can recover X dollars worth of copper from an ore, and it costs you X dollars to get it into a metal bar or sheet, whatever the product is, that's not a mine. You know, my rule of thumb is that all the costs built into it have to equal about half the value of the commodity that you can derive from it. But I think you need to always look at the fundamental economics, make a stab at stripping ratio, at recoveries, which are commonly discussed in all the Carlin type company news. You've got to know what the recoveries are going to be. You've got to know what the mining costs within a range are going to be, and just rough it out. Is this something that could make sense? If they've got a 500,000 ounce deposit of refractory ore, quarter of an ounce type grade, is it really possible this could be a mine? If it's going to cost you $500 million to build an autoclave to treat it, not going to work. So always never forget the economics. Those are the drivers. Everything we've done over the years, I start right away roughing out how much do we think we might have, and what's it going to cost? Is there a chance that this could be an economic venture? And that's always what you have to focus on, at least to me.
I have words to the wise, and I will second that, and maybe go one further. Just if you're going over a company's presentation, their PowerPoint on their website, and it's all full of pictures of, you know, the Klondike gold rush 100 years ago, and the gold nugget your grandfather found 30 years ago, and all kinds of stuff. You know, it's exciting storium, but but there's no data or little data on what do we have. You know, what's it worth? What might it be worth? What would it cost? You know, whenever there's what Ron said. So I understand how exciting it is, and especially when there's past production. It's just so romantic to see, you know, these old mine shafts, or you explore underground and you can see, you know, where the vein was taken out, and you can see, literally see the hanging wall, right? The footwall. It's cool, it's exciting, and the old timers left all this high grade stuff below the water table because they didn't have enough pumping. It is an economic venture, and if it's going to cost you more than to produce, you have nothing. So Ron, I agree with you. Thank you so very much for your time. We'll put out links, and to the audience, I will put out timestamps here if I can, and hope we'll do this again sometime. Thank you.
Anytime, Louis. Always appreciate the chance to chat with you, and you have to come to Nevada more often so we can break some rocks. So.
Indeed. All right. Thank you.
You bet. Thanks.
Thank you for watching. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.